Welcome back to the deep dive. Today we're going to tackle a term that, let's be honest, sounds a bit scary in the crypto world. Locking money.
Yeah, it definitely can raise some eyebrows, makes you think your funds are stuck, maybe even gone.
Exactly. That immediate reaction, especially compared to, say, your bank account where you expect instant access, it feels restrictive.
It does, and that initial apprehension is understandable. But what we're really talking about today is something called a staking-based launch and reward protocol.
Okay.
And while that word lock gets thrown around, this mechanism is actually fundamental. It's really common across major global projects. Think Binance, Solana,
Polygon too, right?
Polygon, launch pads like Redkite, and yes, even newer platforms that are building on these models like AIFEEX, which we'll touch on.
So our goal here is simple. Cut through that initial fear. We want to clarify what this locking really means, why projects use it, and honestly, how understanding it can shift your perspective.
Turn that worry into, well, strategic insight.
Exactly. And as always, we're digging into the sources you've provided, pulling out the key takeaways. All right, let's dive right into that main concern. The word lock. It just hits differently than in traditional finance, doesn't it?
It absolutely does. In the traditional world, liquidity is everything.
Yeah.
You want your money now, 24/7. So locking sounds like, well, like a penalty.
Or worse, maybe a scam, especially if you're new to DeFi. You hear locked and think, is this a rug pull waiting to happen?
That's the core misconception we need to address.
Yeah.
In DeFi, especially with launch pads and new projects, what people often call locking is much better described as staking.
Staking. Okay.
And it's crucial to understand this isn't someone seizing your funds. Not at all. Think of it more like making a commitment voluntarily.
So you're actively choosing to do this.
Precisely. You're demonstrating support, dedication to a project or a network. And in return for that commitment, you often get perks.
Perks like what?
Like early access to invest in new tokens, maybe higher returns than just holding sometimes even a say in how the project is run. It's an active role.
So it's less like a locked box and more like putting down a deposit to show you're serious and getting something back for it.
That's a much better way to think about it. It's a fundamental difference from traditional finance. It's designed to build stability and encourage, actual participation.
That reframing is really helpful. It's a trade-off, a strategic choice. And it sounds like this commitment, this staking, is a key piece of a project's overall economic plan.
Absolutely. It leads us right into tokenomics.
Right. Another one of those terms that can sound intimidating. Coin allocation, vesting schedules, cliffs. It's a lot of jargon.
It can be, but what's fascinating is how staking acts as a cornerstone within that tokenomic structure. How tokens are given out, when they become available. It's all incredibly important.
Why is it so critical?
Well, it directly impacts investor confidence and supply, and ultimately the token's price stability over the long run. Staking isn't just holding. It's a tool projects use very strategically.
Strategically how? What's the goal?
Primarily to build stability, especially early on. Imagine if millions of new tokens hit the market all at once at launch.
Yeah, the price would likely tank. Chaos.
Exactly. Staking prevents that kind of massive, immediate sell-off. It takes tokens out of active circulation, just temporarily. Secondly, it encourages long-term thinking.
How so?
When people stake, it signals they believe in the project for more than just a quick profit. It reduces that constant selling pressure and gives the development team breathing room.
Breathing room to actually build what they promised on their roadmap.
Precisely. Without worrying that every market dip will derail them. And you mentioned vesting schedules and cliffs. That's where it gets even more sophisticated.
Tell me more about that. It's not just one unlock date for everyone.
Not usually, no. Often you'll see a cliff. Maybe no tokens unlock for, say, 6 months or a year. Then after that, they might unlock gradually, linearly, over more months or even years.
And that's applied differently to different groups.
Often, yes. Project teams, early backers, advisors. Their tokens are frequently locked for much longer periods, sometimes years.
Why do that?
To show serious commitment, skin in the game. It proves they believe in the long-term success and aren't just going to dunk their tokens on the community as soon as possible. It aligns everyone's interests.
Okay, that detail really changes the picture. Locking isn't arbitrary. It's a deliberate design feature for sustainability.
Exactly. It's a calculated part of the economic architecture.
What's really powerful here is knowing this isn't some, wild new experiment. You mentioned big names earlier.
Right. This is in theory. It's proven practice.
Hmm?
Think about Binance with BNB, Solana, SOL, Polygon, Matic, even launchpads like Redkite we talked about.
These are huge, successful projects.
Absolutely. And all of them use staking or similar locking mechanisms before they hit the mainstream, often before they were even listed on the big centralized exchanges, the CEXs.
Why then? What was the strategy?
Well, take BNB. Staking BNB was often required to get into Binance launchpad deals, access to new token sales. That commitment reduced the circulating supply of BNB, helping its price.
While also helping new projects launch. A win-win.
Exactly. And for Solana and Polygon, staking SOL, or Matic, is fundamental to their network security. It's proof of stake. Users stake to validate transactions, secure the network, and earn rewards.
So it's baked into the core function of the network itself.
Deeply baked in. It builds robust infrastructure. And Redkite, they use tiers, stake more of their token, get better access to new project launches. It incentivizes holding and participating.
Okay, so they use it pre-launch or pre-mainstream listing, but what about when those tokens do get unlocked, often around the time of a big CEX listing? Isn't that the risky part?
That timing is actually where the strategic genius often lies. It's usually very deliberate. Unlocking, then, isn't about everyone running for the exits.
No. What is it about then?
It's about transitioning. Suddenly, you have a massive boost in market liquidity. That's vital for price discovery, for actual trading to happen efficiently.
So it makes it easier for more people to buy and sell on a big, trusted exchange.
Precisely. It builds confidence for retail investors. They see it listed on, say, Binance or Coinbase, and there's liquidity. That stimulates trading volume, awareness. It gets the ball rolling.
So that unlock, timed with a CEX listing, can actually be the catalyst for significant price growth.
Often, yes. It marks the shift from that initial commitment phase to a much broader liquid market phase. Early commitment gets translated into market value. It's quite elegant, really.
So thinking about this whole picture, for you listening, the takeaway seems clear. These lockup periods aren't suspicious. They're not random.
Not at all. They are a planned, integral part of a long-term strategy. It's about project development, market integration, a calculated step.
Not just a barrier keeping you from your funds.
Definitely not. And if you're wondering how long these periods usually last,
Yeah, what's typical?
based on the sources, it generally ranges from about 3 months up to a year. It varies, of course.
Can you give some examples?
Sure. For something like BNB, especially related to launchpad participation, you might see staking periods around 3 to 6 months. For network staking on chains like Solana or Avalanche,
Those foundational networks.
right, their proof-of-stake mechanisms often involve staking durations more in the 6 to 12-month range. Polygon's Matic tends to be similar, 6 to 12 months for network security.
And sometimes longer.
Yeah, projects like Cardano, with ADA, tied to their Ep4 cycles, can sometimes see staking commitments extending up to a year or even more, depending on the specific pool or setup.
And the reason for these different lengths always comes back to
The core goals: stability in the early days, giving the project room to grow without massive volatility, and crucially, giving the development team enough time to actually build and deliver value.
Makes sense. Shorter periods might mean faster development cycles, maybe? Longer means more focus on long-term security.
That's generally the idea. It signals different priorities.
Yeah.
Of course, you have to mention the risks too, right?
Like what?
Well, there's always smart contract risk. A bug in the code could theoretically be exploited. And there's opportunity cost. Your funds are tied up. Maybe you miss another opportunity in a fast market.
But reputable projects address this.
Good projects do. Through rigorous code audits, transparency, clear communication, these become known, calculated risks within the system, not hidden traps.
Okay. So this brings us back nicely to AIFEEX, which I know is on a lot of listeners' radars. When we place AIFEX's approach within this whole context, Binance, Solana, Polygon, the standard practices, it starts to look quite different, doesn't it?
It really does. The key thing to grasp, and this is important, is that AIFEX is using this exact same globally recognized mechanism. It's standard practice.
So it's not some strange outlier doing something risky or unusual?
Not at all. When you see the bigger picture, you realize they're adopting a strategy the market leaders have used successfully. It's about fostering stability and long-term growth, just like the others.
So that initial worry about locking?
It really just boils down to unfamiliarity. People aren't used to how this new financial world operates. But in reality, this waiting period, this commitment, has historically unlocked significant opportunities. Potentially much greater returns than traditional systems often allow for early participants.
It sounds like understanding this is key for anyone looking at new projects, including AIFEEX.
Absolutely. If you approach this from the perspective of a, let's say, strategic investor,
Right.
the ones who grasp these mechanics early, they're like the pioneers who saw the internet's potential way back when. It's not just about holding coins blindly.
It's about understanding the rules of the game.
Precisely. Holding coins with a deep understanding of the dynamics at play. Recognizing that this initial staking or commitment phase is designed to manage supply, build a strong community, let the project execute its vision.
So understanding that is crucial for evaluating AIFEX's potential properly.
It's paramount. It allows you to look past the surface-level fear of the word lock and assess their long-term vision, their strategy, from an informed, principle-based standpoint. You can see the potential advantages built into their model.
Okay, so let's try and bring this all together. The core message from our deep dive today seems to be that staking or locking isn't something nefarious.
Far from it.
It's a standard, well-reasoned tool in the crypto toolbox. It serves real purposes, boosting potential returns, yes, but also fundamentally supporting project stability and long-term success.
It just requires a bit more digging and more strategic understanding than just looking at a surface-level chart.
Right. It's about understanding the why behind the what.
Which leads to, I think, an important question for you, the listener, to reflect on.
Go on.
Now that you have this deeper understanding of these mechanisms, staking, vesting, strategic unlocks,
Yeah.
how does that change the way you might look at any new digital asset opportunity? Because many new projects will have their own unique rules, their own variations on these themes. Does understanding the principles help you move past that initial gut reaction, that fear?
Does it allow for a more rational evaluation?
Exactly. A more principle-based assessment. Does it help you truly see the potential vision of a project, like AIFEEX, by understanding the strategic game plan they're deploying, just like you would evaluate any other major investment?
Something definitely worth pondering as you navigate this constantly evolving space.